Update time. How's everybody doing out there? Yes, I want to give you an update on what is happening. Of course, yesterday the Fed raised interest rates 25 basis points to 1.25 on the Fed funds rate. And we saw the typical zombie reaction. We're still seeing the zombie reaction, which is to buy the dollar, to sell gold, to sell commodities. That is a wrong reaction. That is the wrong reaction. And I'm saying this right now very emphatically, that is the wrong reaction. I'll get to stocks in a minute. First of all, the way to think about rate adjustments, and I've spoken about this in the past, there's a very simple and clear way to think about rate adjustments, and they are price adjustments, okay? When the Fed raises rates, they are raising the general level of prices because the cost of credit, which is what they're doing when they mess around with the rate. When they adjust rates, they are, adjusting the cost of credit, and the cost of credit is reflected in the cost of all goods and services, okay? When they cut rates, they are lowering general prices for the same reason. Lower the cost of credit. The cost of credit is reflected in the cost of all goods and services. This is why when we had the rates, when the Fed brought the rates down to zero during the crisis, and all the idiots out there thought there was going to be hyperinflation and the dollar was going to crash, they didn't understand that that was deflationary. They were reducing prices, and each incremental or each cut in the rate reinforced the need for more rate cuts, at least in their minds, right? They cut the rates. The result was a deflationary result. They saw that in the weak growth data. They saw that in the weak inflation, and then they said, oh, we better cut rates some more. But that just exacerbated that condition, all right? Same thing on the upside. When you hike rates, you raise the general prices. Basically, this is the way that, this is kind of the orthodox economic way of trying to manage the economy is by managing the price level, all right? It doesn't really work very effectively, but that's the orthodox economic response. The mainstream, what they believe in is by manipulating the price level, which in fact, that's what an interest rate is. It's the price of credit. They believe that they can manage the economy effectively that way, but they really can't, all right? So if you understand it at that level, which I tried to explain it in a very, very basic level, I'm telling you right now that when they raise rates, they are raising the general level of prices that is not bearish for gold, that is absolutely not bullish for the dollar. I always laugh at this. It makes me really, it amuses me to no end, because the very definition of inflation is that your money buys less. So to think that suddenly that would equate to a higher foreign exchange value of your currency is ludicrous. It's not going to happen. It happens short term because the zombies believe that. It's a belief system, but it's wrong. You sell the dollar on this. You buy gold on this, you buy commodities on this, and you just be patient. It's going to turn around, and the market is handing you a tremendous opportunity. As far as bonds, we saw a rally yesterday. I said that was going to be reversed, is somewhat reversed today. There is no way you buy bonds when the Fed is in a rate hike mode. Now, there might be a disconnect for a certain period of time, again, based on a belief system. Everybody, and the fact that everybody was maybe short bonds going into this. But eventually, if the Fed is hiking rates, bond yields are going up. I mean, what is a bond? It's the expectation of Fed policy over the term. So a 2-year reflects the expectation of Fed policy over a 2-year term. A 10-year reflects expectation of policy over a 10-year term. The longer the Fed remains in its mode, which is right now rate hike, eventually the bond market's going to not just realize this, but it has to conform to what the Fed is doing. It's just a monetary fact, all right? So bonds are not a place to be buying. You know, if you want to be, if you're just like scalping it and you think you're savvy with that, then, you know, good luck to you. But I mean, you do not want to buy bonds when Fed is in the rate hike mode, and you do not want to short bonds when Fed is in a rate cutting mode. It's very simple to make money. The question is, do you have the patience to sit it out? Or you're just going to do what the zombies do and make money sometimes and think you're very smart and savvy, but you're not. You're going to end up losing it. As far as the stock market is concerned, there is another aspect to rate adjustments, and that is the fiscal aspect. And I talked about this all last year when there was such a worry and a panic among everybody about the Fed raising rates. And I said it was a fiscal stimulus, all right? Because since the government is a net payer of interest, if you raise rates, it is effectively a net increase in national income, all else equal, all right? So if that happens without, and it's happening, by the way, you're raising income without an offsetting increase in output. As a matter of fact, you could be curtailing output somewhat because higher rates, the cost of credit goes up. Maybe some firms, you know, that impacts them in terms of their productive output. So it's inflationary too. So here's where the stock market, you know, initially, you could see the stock market has kind of shrugged off all these rate hikes. But at some point, the inflationary effect, that means where the cost rises, but the demand is not necessarily rising at the same pace. You see profit margins narrow, all right? And maybe we're at the tipping point now. I don't know, the market's down today. NASDAQ is down, making a new low from that kind of flash crash we saw on Friday, making a new low today. The Dow is kind of, you know, hanging in there. But we'll see. Maybe we're at that tipping point where the market starts to discount a narrowing of profit margins, and then we see a broader correction that is sustained over a longer period of time. So far, that has not happened, all right? But the main thing here is that it's inflationary. You've had a price increase yesterday. It takes a little while for all that to filter through the economy. Don't forget, you know, people say, well, Mike, I don't see it in the data. Okay, well, in December 2015, at the first rate hike, the annual rate of inflation was 1%. And now it's at 2.2%. You know, come down a little over the last few months, but it's still double what it is. And we've had 4 rate hikes already. Okay, and I've been through this with the gold. Gold was at 1,050 in December 2015, and now it is at what, 1,260? Yeah, it's come down off of what, earlier or last week it was at 1,298 or something like that. But it's gone up. 4 rate hikes. Dollar yen was at 121 in December 2015. It's at 110. All right. So I mean, come on. You got to stop with these arguments that are hollow. I mean, you got to look at the facts, at what happened. So that's the way to think about it today, folks. That is the MMT understanding. That is the correct understanding. That's the way to make money, and just do what you got to do and be patient and go against the zombies. You kill the zombies. But I do have zombie trading in beta test, and it's coming out very soon. And when it does launch, I will let everybody know. You get a 30-day free trial. Check it out. It's for all you people out there who like to, you know, hit it big, very quick. You don't like to wait. You want your money right now. I built something just for you. You see how I care about everybody? I care about all of you. See you later. Bye-bye.